When you come to finish as a final speaker on one of these panels, very often you're sitting there thinking, am I going to violently agree with some people or violently disagree with everybody? And I think it's fair to say that if you reflect back, if we were having this debate, I think back in 2009 or maybe early 2010, I think I would probably have a very different view than the one I think the view I've reached on in terms of this debate at the moment. And there have been a number of comments that have been made which I absolutely would agree with the analysis. I think possibly my judgment at the end in terms of what's the answer might be slightly different. And I think that that's why this is such an important proposal, because it's one could easily have a shrillness in this debate, but actually, you know, listening to what Alain says, a lot of his analysis I would agree with. You know, some of the stuff that Jakob said, and equally Jens, you know, I can see absolutely those balances. But one of the things I was thinking about in terms of a few opening remarks of this of today is, you know, why are we doing this? And it's probably a bit wrong to have got quotes around these things, so they're not direct quotes, but I would hope most people would recognise the four big things I think that we're trying to deal with in this. We're trying to think about where are those residual risks in the system that we're seeking to try and either push out gently or to try and manage away. Where do we really want our banks' balance sheets to go to? I think there's absolutely no doubt. I think there would be complete consensus in this room that many banks' balance sheets have got far too big pre-crisis. We all equally would agree with the sentiment in terms of taxpayer risk, that none of us would want to be in the position where the implicit guarantee point. But I think, personally, I think there's a big difference in terms of actually having taxpayers having to write those big cheques that they wrote, and coming from a country where the cheques were even bigger than the rest of Europe, kind of we all know what that feels like more than some other countries in terms of the difference between implicit guarantee and actually the government having to write cheques. And I think the fourth one is this complexity issue in terms of resolution. And there have been some very good points made, so I'm not going to try and repeat those. You know, Alain talked about the various legislative proposals that have been put in place to deal with a lot of this stuff. I think there are four things I would talk about. The first one is the role of the ECB. The SSM proposal, and in this context I see quite a lot of similarity in the way that the Bank of England in the UK, along with one or two Nordic countries, in terms of the way that the supervisory process is beginning to evolve. You know, the so-called SREP process, and I apologise if that sounds a little bit technical, but the willingness of those new supervisors in Frankfurt to really challenge what banks are up to and what their strategy is, but also the competence with which they can do that, and their willingness to use a Pillar 2 adjustment to drive out if there is excessive behaviour going beyond the, quote, acceptable level, one that the board have set, and those people being responsible for that, and some consequence to those people if they don't keep the management team under control. So that would be my first point on the ECB. And I think we haven't given that a chance to work yet, and I think that there is, I have a good degree of confidence that the competence of that organisation will be able to deal with some of those behavioural issues that's implicit in some of the comments that have been made by different people on the panel. The second issue, I think, is the thing that Jakob talked about, the role of TLAC and bail-in and all that stuff, and some of the proposals that we have seen finally land in Brisbane at the weekend. Where those investments, where that bail-in capital will sit, bail-in bonds will sit, you know, I think is an interesting debate in terms of whether we're going to end up with an SPE or an MPE strategy. And the thing that really I don't think there's been much ventilation on, and I find it difficult to speak to personally because it's not within my own personal experience, is where will investors want those bail-in bonds to be? And my instinct tells me that they will want those bonds to be somewhere, if they're going to have to take an equity stake as a result of bail-in, the last place they want those bail-in bonds will be up at the top of the organisation where there are no assets apart from investment in some subsidiaries. My instinct is that they're going to say, unless you want to pay an enormous coupon I want to be able to actually have an investment in a trading activity or in a little subgroup in a trading book. So I think that drives to an MPE strategy way down the organisation in terms of where that bail-in will sit. And what does that mean in terms of TLAC is that you will get a lot more discipline, it seems to me, in terms of where the investors think that the structure should work. And so an imposed structure, in terms of what the Commission's proposal is saying, given that it's only for 30 banks, I'm not sure that that is the most efficient way of doing it. It seems to me that if the investors are getting after this issue, and we can all go and inquire, and I think it would be useful to have some academic research in terms of what the investors are looking for, but I think we could be in a position where the investors will insist on some of this stuff, and they may say, actually, we want it in a different structure because we want to have access to that, or they may say not. And if it's only 30 banks, a combination of the ECB, the SSM, plus other competent authorities in Europe, plus what the investors are looking at, I think I would say with a fair win would to a greater extent solve this problem. In terms of prop trading, my instinct is that if you have retail deposits funding an organisation, it does not feel comfortable to have that funding prop trading. And I draw a big distinction between prop trading, where it's completely for your own benefit, as opposed to where you're providing liquidity for the sell side, as the sell side for the buy side. And I think for those mutual funds and the insurance companies, they need some people to be able to hold inventory, and I think that there is going to be a demand for some capacity to do that. I think many people, including a lot of bank managements, would say, actually, prop trading is no longer on the agenda for us. And I absolutely know the issue in terms of corporate memory. Will it creep back in? Well, I think a combination of what the investors are saying, what the ECB is saying as a regulator, but also in terms of what management will do if they're going to have a change of strategy, will drive a lot more discipline around that. I think the fourth point I would make is in terms of Capital Markets Union. I think everybody is really pleased from across the whole union of what the new president has talked about in terms of trying to rebalance the financial services sector between banks and some form of Capital Markets Union. We don't absolutely know yet, and I'm sure there's good work going on in the Commission in terms of thinking some of the practical things of what this could be and what it could look like and what it could feel like. I know there's an awful lot of thinking going on in the major centres as to what this will look like. What I'm keen to see is that we don't destroy effectively one of the components of that, which is people, intellectual property, because I think we all want some form of Capital Markets Union that can provide that financing for jobs and everything that goes with that bond finance, which I think could be very, very important, such that we end up with a reduced size banking sector. But we do need to make sure that we don't destroy that in the short term. We don't destroy what we've got that provides that infrastructure, which in due course, with the evolution of TLAC and the expense of funding it, could mean that naturally that things would move out of the banking sector into a broader and better formulated capital markets within Europe. And I think probably at that point I will leave it, because I suspect that's about my 10 minutes. But those were the 4 big points I think that I would like to make over and beyond the comments that I have heard from the Alain and others, and I think we're in a position where a lot of the analysis, I think I'm hearing agreement on. I think it's the judgments in terms of at the end of the day is where there is a difference. So thanks very much.